All right, let's jump right into this explainer and look under the hood of institutional grade commercial real estate. If you've ever walked past a massive downtown office tower or maybe a sprawling new apartment complex and wondered exactly how those deals are structured and financed, well, you're absolutely in the right place. Today, we're unpacking the exact mechanics of real estate private equity, or REPE. We're going to strip away the jargon and look directly at the precise mathematical and structural engines that power these multi-million and honestly sometimes multi-billion dollar transactions. We'll be walking chronologically through the lifespan of a deal, treating the whole REP process like a rigorous manufacturing pipeline. We'll cover the deal funnel, the underwriting engine, the capital stack, due diligence, and finally, the equity waterfall distribution. Okay, starting with part one, the REP deal funnel. Before a building is ever bought, you've got to establish a massive structural framework to actually hold the capital. To really grasp how these assets are manufactured, we first have to look at the huge timeline governing these institutional funds. REPE funds are typically structured as closed-end limited partnerships with a lifespan of around 10 to 12 years. During that initial 1 to 2 year fundraising phase, capital commitments are legally locked in. Then the fund enters its most active stage, the 3 to 5 year investment period. This is where the clock is officially ticking, and the general partners, the GPs, have to actually deploy the capital they just raised. And that ticking clock? It creates immense pressure. I mean, how do you go out and find $1 billion asset that perfectly matches your fund's specific risk and return mandate? Picture a massive 3D pipeline where dozens, if not hundreds of properties are getting aggressively squeezed into a tiny, narrowing opening. For acquisitions teams, the top of this funnel is an exercise in extreme, ruthless filtering. These teams are evaluating hundreds of teasers and confidential information memorandums, or CIMs, every single month. These docs get them high-level financials and asset descriptions. The team's entire job here is to rapidly discard marginal opportunities. Why? Because they have to focus their highly limited underwriting resources on only the absolute highest conviction targets. It's basically a game of saying no 99 times, just so you can say a highly researched yes exactly once. Moving on to part two, the underwriting math engine. Once a target actually survives that brutal initial filtering, it moves straight into the modeling phase. Underwriting acts as the true mathematical engine of the entire transaction. A disciplined team runs a standardized 7-step framework. Picture a highly complex spreadsheet model where they're inputting leasable square footage, modeling future tenant renewals, and estimating structural capital expenditures, stuff like a new roof or a massive HVAC overhaul. Finally, they apply an exit cap rate. That's essentially their expected rate of return upon selling, and they use that to back-solve for their initial offer price. Now, the crucial pivot point in step 4 of that framework is isolating your costs to solve for net operating income, or NOI. You take your effective gross income, which accounts for actual cash revenue after vacancies, and you subtract your operating expenses. Analysts have to perfectly separate controllable expenses, like landscaping, from non-controllable ones, like property taxes. NOI is essentially the central nervous system of real estate analysis because it's the primary valuation metric used to determine exactly what the property is actually worth. All right, part 3, building the capital stack. With the underwriting math locked in and an offer price in mind, the acquisitions team now has to figure out how to actually pay for the thing. They do this by engineering the capital stack, literally layering the money vertically in the transaction. Priority flows upward from the bottom, while risk and return flow downward from the top. Senior debt forms that rock-solid, low-risk foundation, secured directly by the real estate itself. And because it's the safest layer, it has the lowest return and gets paid first. Squeezed in the middle, you've got mezzanine debt and preferred equity. Finally, common equity sits at the very top. These guys are paid absolutely last, taking on the highest risk, but in exchange, they demand the highest potential reward. And to protect that senior debt foundation in today's market, lenders aren't taking any chances. They demand incredibly strict risk thresholds, like a minimum 1.25 to 1.35x debt service coverage ratio, or DSCR. Basically, this means the property's net operating income must be at least 1.35 times larger than the mortgage payment. It creates a critical safety buffer. If the property underperforms, the lender knows for sure there's still enough cash flow to cover the loan, well before the equity investors see a single dime. Which brings us to part 4, due diligence and verification. Let's see how the pressure really builds once the offer is accepted and the capital is lined up. A signed contract immediately triggers the formal due diligence phase. The reality of due diligence is a totally grueling 30 to 90-day window to verify absolutely every single assumption we just made in our underwriting engine. The team is leaving zero stones unturned here. They are actively hunting for hidden physical damage, zoning compliance failures, boundary disputes, or terrible tenant contracts. If you find a major issue here, you've really only got two choices. You either renegotiate the price or you walk away entirely. It's essentially a two-front war. While financial analysts are busy indoors auditing 3 years of historical profit and loss statements and cross-referencing bank statements against tenant payment histories, third-party engineers are outside physically inspecting the property. They're conducting boundary surveys and Phase 1 environmental site assessments to unearth any deferred maintenance or contamination. You are literally checking for toxic waste before you hand over the money. Finally, we arrive at Part 5, the equity waterfall distribution. So the deal is closed, the property is acquired, improved over several years, and eventually sold for a massive profit. Now we reach the absolute culmination of investor distribution math, the joint venture equity waterfall. The waterfall dictates exactly how the profits are split between the investors who put up the capital, the limited partners, and the operators who actually did all the heavy lifting, the general partners. And here's the kicker. It splits profits unevenly to reward the general partner with something called the promote or carried interest. It's a performance incentive. It gives the sponsor a disproportionately larger slice of the pie for executing a highly successful deal. You can think of this framework as a tiered system. In Tier 1, up to a 10% return, profits are shared equally based on how much money everyone put in. This is known as pari passu. But if the sponsor crushes it and pushes the returns past 10%, they hit Tier 2. And the GP starts taking 19% of the upside. If they do incredibly well and hit a 15% return, they reach Tier 3, and suddenly that GP is taking 37% of the profits. The better the investment performs, the larger the share the operating partner takes home. And it's literally called a waterfall because you have to imagine it as fluid dynamics. The cash flows strictly downward, entirely filling the first bucket's capacity, say paying back all the initial capital, before a single drop can spill over into the next tier to pay the preferred return, and finally spilling over into those lucrative promote tiers. The math is incredibly rigid, it's heavily negotiated in the legal agreements, and it dictates exactly who gets wealthy when a deal succeeds. So what's the big takeaway here? While commercial real estate is vastly more than just bricks, mortar, and leasing signs, the next time you walk past a massive office tower or a new apartment complex in your city, try to look past the glass and steel. Think about the aggressive filtering funnels, the complex mathematical underwriting engines, the heavily engineered capital stacks, and those invisible equity waterfalls constantly operating right behind those walls. It completely changes how you see the skyline, doesn't it? Thanks for joining me on this explainer, and as always, keep looking deeper.